Welcome to episode 3 of the Family Office Sherpa podcast. My name is Shaun Parkin, founder and managing director of Family Office Specialist Hall Road Investments. I'm Australian and I'm based in sunny Perth. Some may know me as the Family Office Sherpa. I have a newsletter of that name, which I send every 2 weeks and cover all things family office investments, technology and operations. In terms of client engagements, I specialise in investment governance, which means I'm often the boring one at the pool party, speaking about investment policy and strategy. I've been a stockbroker, an asset manager, worked on gold mines, and even spent some time in the deserts of Mongolia trying not to freeze to death. Uniquely, I have also worked with the family office investors for around 12 years, assisting clients with assets between $200 and up to $10 billion in structure. What we look to do is improve, start, and sometimes dissuade from starting their own private investment office. This podcast is a series of 5 and aims to be a guide for families and their advisors looking for practical and implementable insights. I am not looking to provide investment advice here, so please read the disclaimer below in the show notes.
This is the Family Office Sherpa.
Episode 3. In this episode, we'll discuss my favourite topic, which is operational infrastructure, specifically investment reporting and technology. When I started Hall Road 5.5 years ago, I asked clients what were their main pain points. And nearly every single one of them said reporting. How to get the reporting across different counterparties, aggregated, automated, and analysed. There was a big movement at the time, as you probably remember, when there was low interest rates, of moving away from custodized or custody assets. So what we were looking to do is solve for what we call non-custodial reporting. So those assets that are held outside of a wealth manager, a fund manager, or a counterparty like a custodian. Really what we're dealing with here is how to get everything across all those idiosyncratic and unusual pricing mechanisms aggregated into one place and then being able to report on it. It was one of the biggest challenges, I think, for nearly every single family office that I spoke to. So as you can imagine, that's where I started to concentrate as a business. So what are we talking about? We're talking about multiple counterparties. If you have a broker, 2 brokers, 5 brokers, how many cash accounts do you have? In Australia, significant amount of different cash accounts. We have direct holdings. We have what we call serviced assets or manual assets. We have all these different types of data points on investments that we're looking to aggregate into one place. And we can only do it in what you probably call non-custodial tracking and reporting structures. There's another reason for this is the move. We've gone from direct investments, but we're also using pricing mechanisms that are coming to us. So how is all the prices from the fund managers and things like that coming to us? They come in PDFs, they come in Excel spreadsheets, they come as direct emails. Some people call up and give us prices. So all these sorts of things have to be taken into consideration when we're talking about investment reporting. And there's a big movement towards private markets. So public markets is actually relatively easy to report on because it's exchange traded. There's also very simple mechanisms you can use. When it becomes manual or there's no price discovery like an exchange or something like that, that's when we start to run into problems and challenges. And really it comes down to who's managing that infrastructure. So that's what we're going to talk about today. We're going to break down the reporting needs of a family office and also the technology that some offices use as well, which we can delve into. Reporting needs. There's 3, maybe 4 main reporting needs that we're looking at. Exposure management, so how are you reporting on the exposures? It's pretty self-explanatory. We can dig into what that looks like. Performance measurement. How are we determining how well our internal and external counterparties and internal staff are performing? How our individual assets are reporting? How is the portfolio performing against benchmarks? And also what we discussed in previous episode, our investment policy. So all these sorts of things to be taken into consideration. And the third one being risk management. So really understanding what the risks associated with the portfolio. So we're going to dig into those 3 right now. So starting with exposure management. People have probably heard the terminology around strategic asset allocation, really the long-term strategic weights that you have within the portfolio. How do you manage that exposure? How do you know if those weights are correct? That's a big part of the reporting demand that we get from clients. How do we know that our strategic asset allocation is there? If we make tactical asset allocations, so those more short-term bets on specific asset classes. How do we know how that's performing, and how do we know what we're actually exposed to? We want to know the geography a lot of the time. US, Europe, emerging markets. If we're Australian investors, how much do we have locally? What's our home bias look like? And also, considering things like getting really deep into the weeds. You might say emerging markets, but you might want to break those emerging markets up into whatever asset class that you make the determination. Some people say that there's significant amounts of asset classes, right? Some people say there's 50, 60, 70. So do you want to break those up into the asset classes and report on each one of those as well? It's all about knowing what you've got in the portfolio. And if you don't have the reporting infrastructure that allows for that, then it's going to be a really big challenge for you. So we're also looking at things like the asset classes as mentioned, but also really how that's implemented. Private markets, public markets, direct real estate, all the fixed income, credit, all these types of asset classes that we need to say to the principal or those stakeholders that are looking at that, at this current point in time, this is what we're exposed to. So exposure management is such a major part of that reporting infrastructure, and one that I can't stress enough. You need to get robust infrastructure for it, and we can go through that, what that looks like. Performance measurement. I'm a big believer in benchmarking. Benchmarking is one of my favorite things because what it does is it makes the decision process between what you're currently doing and what you're attempting to do really clear. So what we're looking to do is track and report the performance of investments, which is such a crucial thing. This includes returns, comparisons, like I said, benchmarks, and analytics of that performance over the different periods. So you got 1, 3, 5, whatever it ends up being. You've got short-term performance, you've got medium-term, long-term. We talked about strategic asset allocation. Most people believe the strategic asset allocation should be reviewed once a year, but it's a long-term 10 to 15-year time horizon that you're looking at with strategic asset allocation. Performance measurement does great things. It helps people assess how the investment decisions align with the family office's financial goals. Again, I'm kind of repeating myself, but going back to that purpose, that investment policy. What's the performance expectations that we're looking for from these assets, and are we meeting those expectations? They've also got things like time-weighted return, in IRR, adjusted IRR. You've got money on invested capital, total value paid in, all these measurements which again decide if you're doing the right job in managing these assets, and the reporting infrastructure needs to be able to do it. Some clients just want IRR. Some clients just want cash balances, but ultimately it comes down to fit for purpose. If the client wants analytics around long-term returns using money on invested capital or TVPI, then you need to have it as part of your infrastructure. So these are the sort of the reporting needs that we talk to clients about. We also think about things like, are we looking at it in aggregate? So is there a mechanism to see the entire portfolio across every single pool of assets that we have? Are we looking to benchmark and determine the performance at the asset class level? At the counterparty level, is my private bank or my wealth manager managing the assets appropriately to the mandate that we want? We don't take their benchmark, we want to report our own benchmark. So there's a big trend these days from going, we take other people's benchmarks, we take other people's reporting and hopefully and rely on them to get it right. No, what we're doing these days is we're putting this infrastructure together as a family office, and we're getting that infrastructure so that we can make that determination ourselves. We can pick our own benchmarks, we can pick our own reporting structure. So when they come in and you interrogate or you meet with them, you say, there's no point talking about how you've gone. We know how you've gone because we've got it in our internal reporting structure. And the other thing you can do as well is things like investable benchmarks. If we had a benchmark here, which was, let's say, MSCI World ex Australia or MSCI World, some sort of total return benchmark or CPI, things like that, what's an investable version of it? Which is to say, if we reduced all our complexity and just said, we're just going to invest it in one portfolio that's managed by someone else, how well would that have done compared to what we're doing now? So really what we're talking about is the performance measurement. And the third one, as I mentioned, so we've done exposure management, performance measurement, and the last one, which is such a big one as well, which is risk management. So identifying, measuring, and managing risks associated with the investment portfolio. There can things like market risk, credit risk, liquidity risk, all those sorts of operational risks, all those sorts of things. If you have good reporting, or the challenge for people without good reporting infrastructure is a lot of that is just an unknown. Things like downside capture, value at risk, things like Sharp ratios. These can all be included within certain types of reporting infrastructure. And this is all the feedback that we get from clients, which is around their challenges. So what does that look like for most family offices? So when we meet family offices across the world, it starts with Excel generally. So if you have a liquidity event and you set up a family office, or you have an embedded family office, so there was already these assets that sat within the office of the operating business, right? It tends to be run by someone that really enjoys Excel, or they're thinking about it from a cost perspective or from an operational complexity perspective and say, what's the easiest version that we can? And I do it all the time too. I track things through Excel. It's really easy. It's hyper customizable. It's part of Office 365. The challenge with that is that you have significant amount of key person risk, and you have the fact that you have data components that may have issues. You may lose the login. There's data security components. There's all sorts of different things. And also you have to know formulas. You have to amend formulas, all these sorts of things. So a lot of people start with Excel, and usually I get called in, or Road gets called in once they've reached either a key person challenge or a complexity challenge. And that's really where we start to come in. So what do they look like? If I got a whole group of family offices in the room, and I do, and you say, put up your hand, who's using Excel? Nearly everyone puts up their hand, and some version of an accounting book or record, accounting software. So in Australia, it tends to be Xero or maybe MYOB. In the US and other countries, you may have domestic versions of that, like QuickBooks or something similar. Maybe more operating business, you might have Oracle NetSuite, or you might have Sage or something like that. So really what we're looking at is an investment book of record, which is recording the investments, right? Usually in Excel, and an accounting book of record, which is the GL software. So these are the two main functions, right? So what we're looking at is the investment book of record. So the three things that we're trying to do: we're trying to automate, we're trying to aggregate, and we're trying to get the analytics from it. So automation means, like I said at the beginning, get all those disparate data sets from all those idiosyncratic pricing mechanisms that we have and getting into one space. We're also looking to automate most of that. So what we don't want is a lot of double, triple handling and manual entry and things like that. So we want to, that's what we want to reduce. That's what we talk to family offices about. And we want analytics, but we want analytics that's fit for purpose. If you have a need for significant institutional grade kind of analytics, then there are platforms and there's solutions for that. If you're looking for less, which to be honest, if you look at it from a bell curve perspective from our clients, most of them sort of sit in the middle there, right? Which is they want relatively sophisticated but not overly sophisticated reporting structures. If they want increased sophistication and things like that, they potentially go to their counterparties. The things to remember are what are you going to insource and what are you going to outsource when it comes to a reporting structure? Because that is a big question for a lot of clients. Like, what are we going to do ourselves and what are we going to get someone else to do for them? That's a big one. Sophisticated versus functional. Complex and sophistication shouldn't be conflated. Like, they're not the same thing. Some of the most sophisticated family offices out there are the most simple, and they require relatively simple but sometimes more sophisticated investment outputs. Versus functional, we just wanted to do this. There's an adage which is, don't let great be the enemy of good. And some people argue with me around that fact, which we should all strive for greatness, but that's fine. All I'm saying is get something functional in place first. And that's what we look to do for a lot of clients. What are the variables going to be to those points, right? We look at local versus global platforms, those that are client services done in the country that you live in and all the tax efficiencies or the tax reporting that comes from that, versus potentially using a global platform that might be more sophisticated, might not be as functional, and the client service might be different. What does it cost? Sometimes these platforms can cost $200,000, $300,000 US a year. There's one that we use a lot in Australia called ShareSite, which costs $60 a month. But obviously they're not the same thing, but there's a wide range in between those two. And of course, Excel, as I mentioned, sort of comes with the package. What's the complexity of the portfolio? What's the outputs that you're needing from that complexity? What custodial feeds do you have? Does it include local benchmarks and other attributes? And what does the client services level look like? One of the biggest frustrations for a lot of family office is I have to wait 2 days to get information back from the global platform because they're not in the same time zone. Or like I am tonight, having a call at 9:30 p.m. What do the integrations between the two look like and other counterparties? So if your major counterparty doesn't have an integration with this particular platform, is that going to be the challenge? Or your GL software, is that going to integrate? It doesn't always happen, but there's processes and there's middleware that you can use. There's a big movement towards AI, and I really wish I didn't have to say it because everyone is. There's an ability for some of these platforms to, in particular for people that don't run them every day, to ask certain reporting platforms questions via machine learning or a version of ChatGPT that sits over their own data set. How much are you going to resource it with? How many counterparties can you use? I'm a big fan of getting the counterparty that you're already paying fees to do a lot of the heavy lifting. And I have done work with wealth managers, private banks and professional services about starting to offer that as a service to family offices. What does the data security look like? What does the access look like? If it's hard to use, then people won't use it. They'll always revert back to their Excel spreadsheet because they know it and they love it. So you've got to really, as I mentioned in the investment policy episode, you've got to bring people along for the journey. You've got to really bring them along for the journey when it comes to software, because people look at it and go, that's too hard. I'm going back to what we know and love. And what does it look like from a total, like a source of truth perspective? So these are all the things that we talk to clients about. In your head, you should be listening and going, that's us, that's not us, that is us, and writing them down and sort of understanding around what does the reporting challenge look like for you. Okay, and finally, what we're going to go through is what are some of the technology options when curating this infrastructure? I'm not going to name names specifically because I kind of want this to be evergreen, because I'm not necessarily, there's been a lot of movement in this space. As an example, some of the big data providers like NASDAQ buying Solovis, you've got CASA being bought by MSCI. You've got all sorts of M&A within the space, within this reporting space. So I don't want to make it too specific to this time, but just so you know, there's a lot of information out there. Or you can just ask me and I'll be able to give you some feedback on some of the software packages out there. So there's going to be 5 main points we cover here. These are the infrastructure. You've got portfolio management software, you got risk management software, accounting and financial reporting software, communication, internal and external communication software, and finally, document management and reporting tools. So as an example, I'm not going to dig deeply into these. Like I said, this is a bit of research, and this is what people really should come to us and ask us about. So portfolio management software. So if you're a family office that is a portfolio manager, or you have a portfolio management team internally, then you need a portfolio management software versus what I mentioned, which is the other version, which is investment book of record. Investment book of record is just, as it kind of name implies, trying to record all the investments and really having all those good things that we talk around, like IRR and MOIC, the performance metrics, the aggregation, the automation and the analytics, but you're not looking to trade through it. You're not looking to manage portfolios through it. So you need to make that determination between those two types of systems. There's overlap between the two, but you've got portfolio management system and you've got an investment book of record. They're not the same thing, they don't do the same thing, and it's really going to be specific to the office. Risk management software, some of the software packages that we talk about, those first two, do have risk management pieces within it, and some integrate really, really well with others. So I think that's one of the integration questions, which is we've got an investment book of record, but we'd love to plug it into a really sophisticated risk management software. So you'll have to have that conversation as well. But it's a different type of software. They tend to be, you try to get specialists. You try to get those that are very, very good at it to make that software themselves. Accounting and financial reporting software, GL software. Like I said, in Australia, it tends to be Xero. In the US, it tends to be QuickBooks and things like that. So really just that's the type of software. And there are integrated versions of it. So that's something to look at as well if you're interested, which they have the investment book and the accounting book together and they interchange. And there is what you'd probably call a single source of truth. There's different versions of that and you need to do your due diligence on if that's going to be appropriate for you or not. But again, they are still different functions. And I can't stress this enough. There's a massive difference between financial reporting and investment reporting. If you're an investment person listening to this and you're running Excel, I almost guarantee that you're getting most of your data from the finance team. So you're getting, because there's There's no fudging GL. There's no, you need, every cash flow is recorded. And so therefore the investment team tends to take that data set from the accounting or finance team, but the outputs are very different. So one of the good things about getting good infrastructure and reporting is that you are going to get a horses for courses or a best fit for each unit. You're going to get finance reporting and you're going to get investment reporting, and it sort of circles up to the family reporting or the investment committee reporting or whatever it looks like. But they are very, very different. Communication software is starting to become a little bit more interesting as well, especially in bigger family offices with a significant amount of counterparties or a significant amount of people that work within it. It's really important to keep those communication pieces together. And there is family office software out there now that really starts to target that. To try and remove the use of emails, trying to remove the use of, from a data security perspective, is just to keep it all in one. The aim is to not go outside the single login a lot of the times, right? So if you can get software that does communications as well, we're starting to see a little bit of that. And the fifth one being document storage, and that's just a massive thing. There's a massive thing from getting it off the F drive, getting it, making sure that you've got version control, all these sorts of things. If you're using public equities, the contract notes in there. If you're using public markets, in K1s, your capital call management structure, all those sorts of things are all kept in there. So you've got documentation storage, because as everyone knows, it sits within family office. There's no harder question than sometimes, where is that document from 5 years ago, right? So being able to access easily and for data security, I think that's been a really big change within the structure. So that's it. That's my favourite bit of the family office structure. I mean, I like investments and things like that, but I just think there's such a powerful thing to happen when people change their operational infrastructure, in particular around reporting. They can be make a massive difference. So thank you for your time. Hopefully it was enjoyable, and I'll see you on the next one.